Okay, we are nearing the end of our quarterly earnings, and I thought I would take a look at expensive options heading into Memorial Day. So, as you know, next week is a holiday, and markets will be closed. I typically like to look and see what's going on around holidays, and I will be doing that in some future videos, but let's talk about some expensive stuff that's happening right now. And it doesn't necessarily mean it has to mean that there are earnings around it as well. But what I do to look at volatility is I use options. I'm looking at near term options. I'm looking at near the money options. And I'm time stamping volatilities on those each and every day. From there, I can create a chart. The ranking I look at is based on a set of near money options and their volatilities over the last year. The way I rank expensive is I take a look at where are we now, all right? What was our high over the last year? What was our low over the last year? The closer we are to the high, that's how the ranking comes out. This is a list of the top 10 most expensive options when you rank them from highest to lowest implied volatility each year. Most of these, by the way, are well off their highs. Typically, when I see these top 10 and I see that high IV and that current IV the same, then I know that there's something severely wrong with the overall market. This is not the case. We have had a really great rebound since the lows that we saw the first week of April. Now, as we're coming into the last week of May, you're going to see UNH at the top of the screen, Target, Merck, FI, MTD's on here, Gilead's on, AbbVie, VSC, AAP, and Deckers Outdoors rounds out the top 10. I want to show you a couple of little quickie things too. UNH, its highest implied volatility of 73.02 is not equaling the volatility of 68.02, but that's pretty high, right? Where was that high implied volatility? Well, it was last week. It was last week when the concern that United Healthcare was possibly involved in Medicaid fraud, and that's what pushed the implied volatility is super high. They're still high. They're still high. Target is also on the screen. 70 was its high, 70.41, 57.28. But look down here at Deckers Outdoors. Its high for the year was 92.36. That's the implied volatility on the options. But look where it is right now, 61.61. It's really in about 2/3 of its high. What does that tell me? It tells me that if you were to look at the S&P 500, or you were to look at the stocks that are all optionable, the majority of them are actually super low in volatility. The top 10, yes, they are the highest of everything that's out there, but they're not as high as they have been. Now, I want to look at two stocks. And I want to look at two stocks because the top two, United Healthcare and Target, have something in common. It's definitely not what they do. All right, but there is something there. You're going to find out about it in just a moment. Here's UNH. UNH is 7 to 140-day at-the-money implied volatility, and you can see the stock chart. The high was above 600. That was back in April. So a month later, we dropped down to 250, and we've rebounded since then. But look what's happened lately. What's happened lately is implied volatility has gone on average from about 35 to last week above 70. That's high. I'm showing you now in chart form what the option traders are looking at. And the option traders are saying that the volatility on the stock for United Health Group isn't anywhere near being over yet. Here's something interesting that I found. When I looked at the money calendar on United Healthcare, I found that 10 of the last 10 years, starting tomorrow, United Healthcare tends to go higher. The lowest on the last 10 years, almost 2.5%. The highest on the last 10 years, near 12%. Now, although this pattern has been dropping slightly, the one thing that impresses me is it has happened over the last 10 years. Again, May 20th to July 18th is the pattern for United Healthcare. I thought I would hand that to all of you that are watching this right now. You do what you may with it. I want to show you Target. Target is another one that has a lower price tag. I mean, back at the beginning of the year, stock was trading north of 140. On April 8th, it was trading down in the high 80s, currently trading in the high 90s. But look what's gone up. Volatility went up into earnings and then dropped. And now, as we have earnings in 2 days, volatility is going up once again on Target. But the same thing's going on with Target is what was going on with United Healthcare. It does have a pattern. It's a 90% pattern, if you will. Back in 2023, when everything was dropping around this time frame, Target dropped as well, dropped about 8% during the pattern. But overall, the pattern is polished. All right, it's positive. And it's up to you to determine, well, I know the negativity is dropping, Tom, and I know you're not a big fan of buying into these kind of negativities. But if I wanted to trade United Healthcare, if I wanted to trade Target, what would you do? By the way, Target is May 27th to July 23rd. So write that down. But again, high volatility, I do not want to be buying call options. All right. I actually want to sell into this volatility. And the way I sell into the volatility is, well, you know how I do it. I use expensive options. If I'm going to be bullish, I'm going to short puts. Why? Well, yeah, they come with large rewards. They also come with large risks, but the statistical probability of being right goes up when I am buying something below market price and I'm getting paid to do so, right? That's called a sell to open put option trade. I get paid a premium for that. And adding that premium in lowers my break even from where we are right now, and that raises your probabilities. So when I look at United Health Group once again, and I see the stock's dropped a lot, it has come back a good bit. This thing's come back about 60 points, maybe a little more, even though the implied volatility is higher. So I might want to look at this and say, well, I wonder if I could set myself up to buy it down here, right? Well, guess what? The 200 puts, this was this morning, were trading around $2.71. I saw them for $3. And so get paid $300 to buy United Healthcare at $200. Okay? Now, how good is this really? I mean, you're not taking in a whole lot, but you are setting yourself up. All right? You are setting yourself up to buy below market price. You are getting paid to buy below market price. How well is this done? Well, for me, 19-0 this year. Okay? Multi-year track record. 5 years back, 90%. 2025, so far 100%. I'm going to go into, I've got a cash flow summit that's coming up. Okay? And it's going to be Saturday, Sunday, Monday. Now, last weekend, I was hanging out in the Gulf of America. This weekend, I know where I'm going to be at noon on Saturday. I know where I'm going to be at noon on Sunday. I know where I'm going to be at noon on Monday. All right, come join me. It's your choice. Sign up now. Ryan, put those registration links up so that the fine folks here can get those. Those will be in the links below, in the description below as well. All right, if you happen to be catching this and you're not catching it live. So there you go, my cash flow summit. Summer Summit, check it out. I think you're going to be real excited on what we're doing.